India just dropped a financial nuke on COMEX, JP Morgan and friends. Starting next month, they are officially ditching Western pricing for their gold and silver markets. And on top of that, they've greenlit a $385 billion pool of equity fund money to pile into physical metals for the first time in history. My name is Nick. I've been a professional investor and unprofessional trader for 24 years. Today, we need to answer one simple question in under 5 minutes. Why is the East suddenly refusing to play by Wall Street's rules, by Wall Street, by COMEX's rules, by JP Morgan's rules, by all of them? This started with China and now it's moving to India too. So let's figure this out together. But first, I'm not a financial advisor. This is not an inducement to buy or sell any assets. Do not take financial advice from some random dude on YouTube, seriously. So, let's start with the actual rule change, because this happened pretty fast. A few days ago, India's financial regulator, SEBI, think of them as like India's version of the SEC, quietly released a circular, a statement, let's call it a statement. Effective April 1st, mutual funds and gold ETFs in India must now value their physical gold and silver using polled spot prices from Indian exchanges like the MCX. Not the LBMA, which is the London Bullion Market Association, and certainly not the nonsense COMEX prices, which we all know are just complete rubbish, right? So that's it. India is done with Western prices. Now here is where it gets interesting, because SEBI did something else at the exact same time. They announced that India's actively managed equity funds, all $385 billion of them, can now invest in physical gold and silver. This is like for the first time ever. So large cap funds can allocate up to 20% to metals. Other equity funds can go up to 35%, if I remember the number correctly. But anyway, Bloomberg confirmed the $385 billion figure. This could bring a tidal wave of new demand from a country that already loves precious metals more than basically anywhere else on earth. In January of 2026, Indian gold ETF inflows more than doubled to hit a number that surpassed equity fund inflows for the first time in history. So basically, they were buying more gold than they were buying stocks, right? India's mutual fund industry has grown 6-fold in 10 years, which is obscene. And now all of it can touch gold and silver. So the cynical observer would say that India just cocked a very large financial gun at the West. But why drop LBMA specifically? And LBMA is kind of like the global standard for gold and silver pricing. And this is the part that really matters. The LBMA price has historically been set by a small group of Western banks in an electronic auction process. And you know, one of those banks is JP Morgan, because of course they are, because they're involved in all of this. Now, under the old Indian framework, the LBMA price got adjusted for rupees, which is their currency, then customs duties, then transport costs, taxes, notional premium, all this kind of stuff, multiple adjustments. And what that ended up leading to is multiple fund houses doing those adjustments differently, which meant that two gold ETFs holding the same metal could have slightly different NAV calculations. It became a mess. That's what you should take home. It became a mess. But here's the bigger problem. There is a persistent gap between what Indian ETFs were pricing gold at and what physical metal was actually trading at in India. SEBI said, and I'm quoting here, using domestic exchange prices shall lead to a valuation reflective of domestic market conditions, which is essentially a nice way of saying, and I'll translate it for you, London's paper prices don't really reflect reality. It reflects COMEX bullshit. That's essentially, allegedly. That's allegedly what they said. Now, the cynical observer, not me, obviously not me, but you know, the cynical observer might point out something about LBMA because they have a bit of a colorful history. Barclays was fined $26 million in 2014 for gold price manipulation. Deutsche Bank was fined $38 million to settle silver price fixing allegations. JP Morgan paid $920 million for manipulating precious metals markets using spoofing tactics. 2 of their traders actually went to federal prison for it. 8 banks total over $1.27 billion in fines across the last decade. Allegedly. Well, not allegedly, because they're fine, so they are real. So when India says we'll use our own prices, thanks, it's not just a paperwork change. It's the world's largest silver consumer permanently breaking the West's grip on silver price discovery. Because India is the largest silver consumer on earth. They pulled in 7,669 metric tons of silver imports in 2024. And then you add in the fact that silver hit an all-time high of over $120 in January of 2026, and that we're in the 6th consecutive year of global silver deficit. The East is not sitting around waiting for JP Morgan to tell them what their metal is worth. So what does this actually mean for your silver if you're a stacker? Here's my honest summary. When the second largest economy in Asia and the world's #1 silver consumer tells you their domestic physical prices matter more than the London paper fix, the paper market loses a bit more credibility, not that they have a lot left. When 385 billion in equity funds suddenly have a mandate to buy hard assets, that is a new demand meeting a market that has already been structurally short on supply for 6 years straight. But as always, my play is simple: no leverage, physical over paper. I don't like paper bullshit. What do you guys think? Also, if you want to see how the Iran war is impacting silver, check out my video on my main channel. Other than that, I'll see you in the next one.